Hi there, Mr. Evans here. We're going to go through a video looking at shareholders in a little bit more depth, their role and why they would invest in a company. So we have worked through these points here, and we're now on the role of shareholders and why they invest. So I gave a definition of shareholders in the previous video. A shareholder is the owner of a limited company who invests capital in return for decision-making power and a share of the company's profits. So shareholders invest their own money in a company, perhaps to have a say in how that company makes decisions, and also for financial rewards. So what is the role of a shareholder? Well, shareholders play a very important role in a market economy. They provide capital, which is money that is invested money invested into a business, which enables the business to conduct commerce. They invest what is known as equity capital invested by the owners that doesn't need to be repaid. So it's a very important source of finance for many businesses, and it enables them to do things like conduct market research, expand into new markets, get themselves set up in the first place. So shareholders played a really important role in terms of providing funding for a company. It is their role to appoint the directors of a company. Many shareholders will be, particularly in public limited companies, will be institutional investors. Bodies like pension funds, people pay into pension funds, and people who work for those pension funds, it's their job to try and maximise returns for those people who have invested their money. Therefore, a lot of investment comes from these kind of corporate investors. They don't have time to be involved in the day-to-day running of a business, nor does somebody who is investing some of their savings. They might have an ordinary day job. They don't want to be involved in the day-to-day running of a business. Therefore, they need to appoint a board of directors who will run the company on their behalf. So that's an extremely important role that shareholders play. Once they've appointed those directors, it's really important that those directors are held to account. Are directors running the company in the best interests of the customers, the best interests of society, etc. Shareholders will also want to review a company's financial performance. How has it done over the past year? Did they meet up to their targets, their expectations? Does something need to change? Okay, how is the company performing financially? Becoming more and more important is the review of a company's social performance. Are the company contributing to society? Are they employing workers on very low wages in poor conditions abroad? Are they doing that at home? Social performance, CSR as it's known, corporate social responsibility, is becoming a very important topic, and it's the shareholders' job to monitor that. Shareholders are increasingly monitoring executive pay. Something that's happened since the financial crisis of 2008 is people have started to question these huge salaries that the leaders of industry are paid, and shareholders will review executive pay and can approve or not of pay packets. Finally, shareholders are able to contribute their expertise and experience to the running of a business. Now, it's worth just making the difference here, highlighting the difference between a private limited company and a public limited company. Public limited companies are those companies that trade their shares on the stock market. They've got these huge institutional investors, not so much involved in the day-to-day running of the business. Private limited companies tend to have their shareholders more involved in the day-to-day running of the business, and therefore more able to make a contribution to the business in terms of their expertise and experience. So it's worth just remembering those differences and how shareholders in those companies tend to operate. So this is a story from the BBC News website. You can see it's April 2016 is the date. BP shareholders rejected Chief Bob Dudley's £14 million pay deal. Essentially, this was the business's annual general meeting, which is a really important date in the calendar of shareholders. They get to attend a meeting with the board of directors, raise issues. This is a good opportunity for them to scrutinise the accounts, scrutinise the social impact of a business, and look at executive pay. And in this case, what happened was that BP are paying their chief executive an awful lot of money, and shareholders did not approve of that. They voted against it. Funnily enough, the opinion, the vote of shareholders was non-binding. It means that this didn't actually go through, but it does send a very, very clear message to the board of directors that maybe they need to review their pay structure because shareholders are not happy. So it'll be interesting to see what happened in 2017 with the chief executive's pay. Look now at why shareholders invest. So why do shareholders bother investing in a company? Well, they provide financial support for an organisation, obviously. They may want to be involved in decision making. Again, shareholders in both private and public limited companies provide financial support. Probably the directors of a private limited company will be more involved in decision making, particularly day-to-day decision making. Shareholders gain financial rewards in terms of dividend payments. That's a share of the profit that is paid every year to shareholders. Shareholders holding ordinary shares are entitled to an equal share of those profits. Okay, so the business takes a certain amount of profits, sees how many ordinary shares there are, and divides those profits equally for each ordinary share. And if you own 20% of the ordinary shares in the company, you will obviously get 20% of those profits. Shareholders also gain rewards in terms of capital gains. So a capital gain occurs when the share price increases. You buy 20 shares at 100 pence a share, pound a share. Those share prices might increase by 50% to 150 pence per share, and you will have made a capital gain. So if you were to sell the shares, you would be ahead of where you were. Finally, shareholders might want to gain control of a business by purchasing 51% of those shares. Okay, so that's a quick look at shareholders.